Hey everyone, welcome back to Pete's Investing. We've finally broken our profits thanks due to the China market, and we'll go through that in the charts and to help explain that. But first, I want to explain that this is not financial advice; it's purely some educational guidelines in terms of how to trade using the average down process and the CCI indicator. As always, don't forget to refer to the playlists. That's where we review the indexes each week. The blue chip shares we review, and the strategies we follow. And the strategies, that shows where we, in terms of which blue chip shares to trade, the simple trading strategy, the average down process, and some money management ideas. So first, let's go into our profit table, which we review each week. And I want to first highlight the margins required for each of these trades. And here we're trading the CFDs for the indices, for these indices. The Aussie 200, the US 500, German DAX, the FTSE, the China market, and gold. Now, we've been doing quite well for all of them with the exception of China, and I'll cover that in more detail. But first, I just want to highlight the margins required for trading one contract. Now, these have risen recently, depending on your broker. As you can see there, the margins required to trade one, and what we're doing is we're trading 5 contracts for each of these indices, just to keep it consistent in our programming, and we're looking at a rolling 5-month period on a 15-minute chart. So it's just to help put that in context. This is our the ASX 200, and it goes back 5 months. So here we are today, 10th of July, and it goes back approximately 5 months. So effectively, that's what we're saying. We're opening the trade back here, and we're letting it run, and this is what it accumulates in terms of profit over the 5-month period. So that's our profit chart. This is our CCI indicator, and this is our price chart. And again, this is a 15-minute chart. So as you can see here, the ASX 200 has done quite reasonably well. It's accumulated just over 3,000 Aussie dollars in trades for our buy-sell strategy. And you can see here, this little chart here shows where it bought and sold the trade, or the shares, or the contracts, I should say. In this example here, it says it opened contracts here, but then it added an average down contracts based on our average down criteria. This is another example where it bought initial 5 contracts. It kept it open for a number of weeks. Then it averaged down again, accumulating another 5 contracts there, and it finally sold out there. It sold those 10 contracts and made the profit. So first I want to highlight for each of the indices the week that passed and how it performed for each of these. So the ASX 200, you can see here on the 5th, which was the Monday, open of trade. It had a bit of a roller coaster ride, but it's pretty much closed almost flat to where it opened up for the week. I'll go through these quickly. The US 500, again opening up here, had a bit of a down slope here, but then it rose above where we opened up. So this is doing quite well for the US 500 in terms of our profits. You can see there on Monday, if our profit there was 2,733, it's currently sitting at 2,846, for example. Then we look at Germany. Again, this has gone pretty much flat, bit of a up and down roller coaster ride, and it's returned back to where we almost opened up. So just not much rise in where we opened up. FTSE, very similar, opened up at that point there, and we're sitting around closing up there. So I won't go into the details of the where it's bouncing up and down above or below the moving average 200, or where it's adding or closing contracts for the CCI 100. I'll let you look at that in the respective strategy videos to get more deep dive into those. Then we look at gold, and again, gold's got a very low margin trade requirement, but as you can see here, where it opened up on Monday, it's risen further up from there. So if you've got to trade gold, theoretically, because of the cost of the margins, $90, you may decide to trade, for example, we're trading 5 contracts for each of these entries. You may want to trade 10 or even 20 contracts. But again, be mindful of the margin requirements for each of these. And lastly, let's look at China. So the China market, again, for opening up here on Monday, it went pretty much flat for the week, but then it closed just a bit below for the week. Now, what I want to do is take you back to the Aussie 200 and I'll review these again and show the 5-month progress and how that's impacted our profits. So again, as I mentioned in the beginning, we've made just over 3,000 Aussie dollars for the Aussie ASX 200, and that's reflective in that profitability point there with a drawdown of 1,600. And remember, the drawdown is the lowest point, so it might have from the high to the low, so that may have been the lowest point from that high to that low. That would have been the equivalent of $1,600 drawdown. That's what it means by drawdown. Okay, so whenever the price dips from a high to a low, that's called a drawdown. So that would have been that high to that low, the highest high to the lowest low. That would have been the maximum drawdown for the 5-month period. So as you can see here, again, as I mentioned, the ASX has gone quite nicely. It's risen. Let's look at the US market. This has done very well as also. It's accumulated $2,800. Again, these are all in Aussie dollars we're trading. And it's doing quite well. The German market, pretty much remained flat for the last couple of months here along this resistance line. But it's as well, it's also risen quite nicely from 5 months ago. FTSE also risen, but hit this key resistance line, and it's bouncing up and down along there for the moment. So let's just keep an eye on that and see how it performs. Okay, I'll show you gold before I show you China. Gold's had a pretty much bit of a roller coaster ride for the 5 months, bit of a downswing here, risen, then dropped out back down again. But it's accumulated $500 in profits for the 5 months. Bit of a red zone here. We fell below our baseline of $100,000. But overall, it's done reasonably well. And lastly, let's look at the China market. Now again, looking at a 5-month period, it's opened up back here. 5 contracts. We just open up this little, where it shows where it's added further contracts. So to open up the initial 5 contracts there at that peak, accumulate another 5 contracts at that point there, kept declining, and according to our average down criteria, it met the CCI breaking above the 0, but also it fell below the average 90-day highs and lows, which is part of our average down strategy. It entered another 5 contracts there. So totally we've got 15 contracts held open since this point back here on the 9th of March. And it's been bouncing up and down along this key resistance support line down here. Now this has fallen below our $100,000 baseline. It's sitting at 67,874. So if you look at our profitability table for the moment, we're down $32,000 on the China market. So overall, even though we've made profits on all the other markets, including gold, we're down just under $10,000 due to the China market. And we use the maximum drawdown, which is the same as where we are in terms of the downside. Now, before we panic and say this is not working, let's look at the monthly summary of what these back test dates. Again, these are all back testing runs we've been doing. So this is where we are today. We've done, again, this is equivalent to what we're showing you back here, 99.38 for the contracts which we're trading on these indices. That's what we're doing today, $9,938 for the 5-month period return, which averages at 1988. If you look at the previous months of trading in terms of our back testing, in June 6, going back 5 months, we accumulated $25,000 in revenue, which was $5,000 monthly. In May 2, for the previous 5 months, we accumulated just over $9,000. In April, we did $18,500. In March, for the 5-month period, we did $24,000, and February 7, we did $42,000. So let's not panic quickly and bail out. Let's just hold on to what profits we would have been making had we held on to this from the previous trades we've been making. before we do anything too drastic. But again, in terms of our profits, let's just also be mindful. The China market has got the largest margin requirement, so it's very volatile, and the CFDs require that sort of margin to be placed on that one, whereas the gold market only requires $90 to trade per contract. So if you're to trade 5 contracts, which is what we're doing in this backtesting here for the China market, again, we're holding 15 contracts at the moment for this backtest. What it's basically saying is we're looking at 15 times 1681 in terms of margin requirements alone, not including the profitability. So again, be mindful when you're trading CFDs that what the margin requirements are per contracts. That's why I'm listing that here, so you can keep an eye on that and make sure your money management is allowing enough funds in your account to allow for such downturns. But again, let's see how it performs next week, whether the China market falls further or whether it continues in a bit of an upswing and recovers our profits. Okay, I hope that's giving you some indication of the pros and cons of trading CFDs and indices. Don't forget to hit the subscribe button, the like button, and the notification bell, and I'll speak to you guys in next week's video. Thank you.